What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently 5:30 p.m. Eastern, end of the North American trading session, Tuesday, August 8th. The schedule I have planned for today is first going through an analysis of market conditions, which I see many traders lack. Then going through a CPI review and rundown, which CPI is on Thursday, but that is the main event in terms of US economic data that's in focus this week, even in terms of overall macroeconomic data. After we go through market conditions and those expectations, and after we go through the CPI review, then we'll, of course, look at current events on the schedule through Asian session, London, and New York, which there really isn't much, and then go into our technical analysis of main market drivers in the pairs we look at, such as US dollar and yen, market sentiment by looking at the VIX, and then going through our individual analysis and trade ideas on gold, dollar pairs, GBPJPY, USDJPY, and US 30 equity market index there for the intraday trade ideas. Okay? First thing on the schedule is market conditions and setting our expectations accordingly. Why is this important? Well, where I see a lot of retail traders fail is not having an understanding of what is driving price from an intraday perspective, or what is driving price from a macro perspective, or what is preventing any key volume and volatility from really entering the market, leading to secondary phases of market structure where you can see large phases of consolidation or large phases of correction and pullbacks. Lacking that foundational knowledge of not being able to assess market conditions has you ignorant to what's really going on in the market and has you getting involved in poor conditions, usually fighting the market. Most people that have been through Capital Hungry and have asked for my help or have met over the years, and they tell me about their journey, they do not necessarily lose trades or lose the majority of their capital when markets are trending or when you have higher volume and volatility and one-sided fundamental catalysts. They're usually losing the most money when they're getting involved in poor market conditions where you have indecision on a current asset class, a lack of major fundamental events, lower volume and volatility, and secondary phases of market structure taking place. So this is very important to understand, because when you can assess the various changes in market waves, when you can assess what will potentially be driving in some volume and volatility, you can make better decisions of how to prepare yourself and set yourself up to either take advantage of those situations, or in certain situations, make the best choice for yourself as a retail trader by just completely sitting out of the markets and waiting for better opportunities. Remember, trading is not like a 9-to-5 job where you're getting paid for your time. Instead, you're getting paid for your skill set. You're getting paid for your information advantage and the knowledge you've amassed alongside your experience. You're getting paid for the patience, discipline that you've developed and the dedication to your trading plan. You're getting paid for these various skill sets and pieces of information that you're refining and developing day in and day out. It's not like the majority of jobs that most of us have worked, where you get hired at a job, you get your basic training, you do your basic daily tasks and show up, and you get paid regardless of the quality of your work, really. I know many people that work jobs where you can just do and run through the same mundane autopilot program day in and day out. You show up, you clock out, you get paid. Trading, a lot of people drag the same mentality into trading, which is going to lead to failure. Some days, it's the best decision you can make is just not take a trade. It's to sit on your hands, analyze the markets, and train your psychology. A lot of people come to me and they say, gee, I have psychology problems. I have emotional trading problems. I have no patience. I have no discipline. And then I ask them, what do you do to train your patience? Are you trading and scalping every single day? Are you looking for day trades every single day without what's going on in the market? Are you always just pulling out your phone, pulling out your mobile trading application, pulling up your laptop, no matter where you are, and starting to analyze the markets for a trade, well, no wonder you have no patience. There's nothing you do in your daily events as a trader to increase your patience or training, right? It's just like if somebody has severe anger issues, unless they take action daily to be self-aware enough to change their habits or intercept their initial impulsive emotions to change their course of action after, then they're never going to solve the problem of having anger issues. They're just going to keep repeating the same poor mistakes and keep exerting the same terrible anger, right? So it's very important to grow your foundational knowledge and understand what's driving the markets, or even from a technical perspective, to be able to analyze whether you're having major volume or volatility or whether you're seeing poor conditions. So far, as we're starting out the new business month, a lot of the US jobs data has been passed and priced in. The majority of rate decisions from ECB, Bank of England, Bank of Japan, and the Fed have passed, had their intraday market impact and been priced in, not holding much more significant weight, as the central banks don't need to be nearly as aggressive compared to the crisis period or when they were front-loading rate hikes. As we have a lack of events in the first half of this week with the main focus on US CPI, we can already see volume and volatility on the intraday has been more skewed. We haven't really seen any continued extensions of current trends, and we haven't really seen any major intraday movement, as we also haven't had anything from a reactive standpoint to drive more volume into the market or to shift sentiment or to support the current narrative. The current narrative that's been holding the most weight from an intraday, even from a little bit of a zoomed out perspective, has been the soft landing narrative, which is keeping equities still elevated, keeping still dollar bearish below the 1980s and still in a bit more bearish structure, and still keeping gold bearish, and still keeping dollar more bullish on resilient data and more optimistic data, as we still have liquidity splashing around in the system from the crisis stimulus phase, right? So that soft landing narrative has been holding the most weight. It's still holding the most weight, but the market focus is on CPI this week. So how can we assess these market conditions? Well, one, we already understand that we have a lack of economic events, a lack of fundamental events. And we can see in the example of US 30, when we're looking at equities, that we're in a secondary phase of market structure. Of course, we've seen buyers print these impulsive highs, and that's the primary phase of market structure, extending trend. But as we peak these new intraday highs, roughly at 35,600, we're starting to enter more of a secondary phase of market structure, seeing an indecision, which is a consolidation at these highs, right? Even though we're still in a more bullish macro bias on equities, where we could still potentially squeeze out higher before seeing any profit taking by the whales or short sellers coming into the market, we still have to be adaptive to these secondary phases of market structure, where these intraday waves is obviously going to be impacting your scalp or day trades, where you're only looking to be in the market for a period of a couple of hours or a couple of sessions. That's exactly why yesterday's market analysis, we expected that if we didn't break above 35,600, we could easily range back down to 35K again, which we did, and we still bounce from there, ending and closing in the range, right? You could see the night and day difference, even without understanding fundamentals and understanding that markets are more on edge, waiting for CPI data. We have a lack of fundamental events. You can even see just outside of those fundamental points that from a technical perspective, we're no longer just cleanly trending and printing highs. We started to get our first signs of exhaustion and creating more of a consolidation phase, right? Even though US dollar has been more bullish and we've been in bullish formation, we might not be in a technical range, but we're still seeing a similar idea of not having major volume and volatility in the market. Yes, dollar is more bullish as we're in intraday bullish structure, back above those weekly key price levels and historical price levels at 101.5. We've still been having buyers print these intraday highs. We had that NFP priced in, buy the rumor, sell the news play, data-induced pullback get faded out. But what's still showing me of not any major volume or volatility, and the market's still on edge, waiting for some key fundamental events on an intraday perspective, is the fact that we didn't see dollar extend trend or break any higher, right? So we could easily still see dollar potentially ranging back into here, revisiting into the 102s, with the main focus still being, of course, US CPI, where we will need to see a higher inflation report to bring back the focus on the Fed's rate hike cycle and changing that dot plan of the FOMC rate hike path to lead to more demand in the dollar, or the other US economic data, such as economic activity reporting, like consumer confidence at the end of the week and so forth. We still need that data to be optimistic, to still see continued demand in the dollar, to be breaking these highs from a technical standpoint. The fact that we're seeing equities in that consolidation range, in the example of US 30, we're seeing dollar failing to print any new highs, which is obviously going to correlate to examples of EURUSD and GBPUSD not printing any lower lows, and GU, for example, entering a bit of consolidation at these lows, EURUSD failing to break those lows still and showing some more exhaustion there and a lack of volume and volatility. We can see how we're in some secondary phase of market structure. Even in the example of Japanese yen, as we've been playing macro Japanese yen weakness on the ultra-loose dovish monetary policy of the Bank of Japan, and them completely fading out that YCC move and just sticking to their guns of keeping policy ultra loose, that YCC move, the yield curve control headline, really just being a headline to set up prices and create price stability, preventing a free fall in the yen. Even though we've had that yen weakness, we're still failing to break these intraday lows. And with the example of pairs like GJ, even though we're still holding in bullish formation and structure, you can see after this impulsive rally and new highs printed, we have been noticing some more exhaustion, no further extensions of trend just yet, no breaks above 183, no new highs being printed just yet. We've had more of a secondary phase of market structure with that liquidity grab that was headline induced by the yield curve control tweaking headline on the day or night before Bank of Japan rate decision. And even after that, we've still failed to trade above that price point. It just translates to me the lack of intraday volume and volatility and markets more on edge in poor market conditions, right? So what does this mean? Well, for the example here, when we still had GJ breaking these highs and trending higher, this is a primary phase of market structure and impulsive moves, right? During these periods of time where you're seeing very strong intraday bullish price action, continuous highs being printed every session, very minor pullback phases, very clean lower time frame confirms when you're diving into your 5-minute or 1-minute time frame, like we look at in Capital Hungry through the PPLs there. During this period of time, you should be a lot more aggressive with your trading, right? You should be more aggressive with your execution, looking to possibly scale in positions, looking to extend trades further and hold the risk-free runners and so forth. But when you're entering some of these secondary phases of market structure, when you're finally starting to show periods of indecision and failing to break higher and getting some of these aggressive pullback phases, or getting some of these aggressive consolidation phases, as a manual retail trader where you have so many emotions involved and other factors that impact your decisions, you should adjust your attack. You should adjust your attack appropriately to these conditions, right? So you should be way less aggressive when you're just seeing these technical consolidations, really focusing on key intraday high or low prices, not really looking to marry or hold any positioning, because we're not investors, we're day traders. We're looking to hold trades for a couple of hours, couple of sessions. Some people are scalping, only looking to hold trades for minutes, right? So these different phases of market structure are very, very important to us. And we have to be able to assess that, as we can see in the example of dollar at the current moment. Even though we're still in bullish formation, even though we're still in bullish price action, still failed to extend and break new highs. Even though Japanese yen is still macro bearish for those fundamental reasons stated, and we're playing that macro rate differential of a more hawkish Bank of England, still keeping rates up higher for longer, while the Bank of Japan is keeping an ultra loose monetary policy. Even though we're clearly bullish on GJ and have been bullish, we're clearly also in a secondary phase of market structure, showing a lot more indecision at these key higher time frame highs, right? We may very well remain in the secondary phase of market structure until we have more important events come into the table. And for reference, when you're looking at something like GJ, for example, you're usually going to see the secondary phase of market structure take place at new higher time frame, new intraday highs, or previous intraday highs. Like, for example, you can see when you are trending here or trending here, the example here, 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 and now we're just looking at here, right? Most people, when GJ's trending bullish and they understand the overall macro trend, they're not losing money as GJ's trending bullish to these highs or extending into new highs, right? They're losing money in the secondary phase of market structure when they're just married to a singular bias, when they just have the same expectations day in and day out, not understanding the fundamentals or key events. And then when GJ is consolidating for 2 weeks or having a pullback phase lasting a month, that's when they're giving back all their gains or losing the most money, right? This is why having that foundational knowledge and being able to assess market conditions and then set your expectations accordingly is so important. So in the example of Euro USD, we have been playing, of course, that dollar strength. It's been very clean from dollar retesting and coming back above that 101 area. ECB just bringing a slow and steady priced in sentiment, nothing new to the table, nothing further hawkish to bring demand into euro, still playing that rate differential of a more hawkish Federal Reserve with higher interest rates. And of course, US dollar being the world reserve currency, we had very clean downside moves all the way up into this price sensitivity area, roughly around 1.09, 1.095, where we're starting to show first signs of exhaustion and really failing to trade lower. This means we have a decreased probability of just seeing continued extensions of trend, and we can easily get secondary phase of market structure take place, which on Euro USD, for example, can be consolidations that last an extended period of time. Look at here when dollar was still more bearish and with weaker data at that time and priced in FOMCs and so forth, and euro was still catching that bid. Even though Euro USD was still trending cleanly bullish, you had this period of accumulation that extended from all the way from June 12th to almost July 12th. That's a month. That's a lot of time in the perspective of a manual retail trader where you're not extending trend right away. You're having this indecision in whipsaws up and down, and then you're finally having the order flow accumulated or the fundamental catalyst to support trading higher. I wouldn't be surprised at this near same price sensitivity area now that we see maybe like a similar mirrored movement where we might consolidate in here. Then if we get a higher than expected CPI report, we could still be digging into this area and then later breaking down back into like 1.085s and so forth. Because I am still more bullish on dollar as it's holding above that 102 price point, and especially above that weekly level at 101.5. But what we have to understand is when we can assess the secondary phase of market structure holding more weight. This also gives us so much information to work with. Understanding the correlations and understanding current structure, if we see dollar just breaking those highs and Euro USD trading lower, that's very clean, simple continuation cells to the next key price point above below here to 1.085. But if we see dollar, when you're looking at dollar index individual movement failing to break those highs, relatively flat line, you're seeing Euro USD failing to break these intraday lows, then you could easily get the secondary phase of market structure before continuing trend. You might get this bearish move taking place a day or two later. But if you're trying to enter too prematurely over here, you're going to be getting swept out with that consolidation or liquidity grabs. And then you're going to be sitting on the sidelines when the move actually takes place because you had no clue how to assess market conditions and how to adjust your expectations accordingly, right? This is also a very similar idea. Of course, we're talking about on GJ, just around these highs at 183.5, 184. Similar idea here when you're looking at GBPUSD. Where we had very clean sellers in control on that dollar strength, but clearly into the new business month, showing some signs of exhaustion at 1.27, very similar to what took place over here. So we could easily still be revisiting these price areas before continuing lower. The good thing is I'm still looking for more dollar strength, and GBP should still be relatively flatline against the dollar from more of a macro perspective, as of course we had the Bank of England take a slow and steady approach and not really bring any new hawkish events to the table with last week's rate decision, right? But the important thing right now is understand that US equities, yen pairs, even when you're coming here and looking at UJ, it's just failing to print any new intraday highs and was really with shitty poor price action here through the entirety of the last couple of sessions. When you're looking at US equities here, that we're currently in secondary phase of market structure, either in some pullbacks or corrections, or these larger intraday consolidations. What does that mean? That means we should be less aggressive. We should be more selective with our trades. We should be more patient. We should even be sitting on the sidelines waiting for the next primary phase of market structure to come back into play. Does that make sense to everybody so far? First part of our schedule webinar about assessing market conditions and then preparing your expectations accordingly. Any questions about that? Now, doesn't look like there's any questions, so I'm going to take that as everybody understands what's going on. Now, this is going to transition smoothly into breaking down CPI a little bit. We might not see any major movement on the dollar on an intraday perspective or on equities or even on gold until we get that CPI data report, especially if we don't have any reactive events when we're analyzing the capital hungry newsroom and overall global headlines, right? If we don't get any reactive events to either shift sentiment or add to the current narrative, if we don't have any major economic events in focus, then we might not see much until US CPI, which is on Thursday, right? If we want to see any type of further strength on the dollar or any type of deeper correction on equities before creating a dip and extending higher, possibly to retest that very important liquidity zone that we broke above around 34,500, we will need to see CPI coming out right on forecast or higher. So let's look at CPI now. If we want to see some more strength in the dollar and focus on the Fed's rate hikes and rates being up higher for longer and changing that FOMC dot plan, if we want to take away from that soft landing narrative on equities, we will need to see a higher than expected or right on forecast CPI year over year change. Now, this is very important because this CPI report this week, this is the first CPI report in months. Don't quote me on it, but it's the first CPI report maybe in 5 or 6 months where we've had a forecast projected to the upside. Why is that? Well, CPI, if you understand the breakdown we've given in the educational webinars about the base effect, inflation has been a lot easier to correct from the monstrous stimulus phase of 9% back down to 3%. This was a much easier job compared to keeping inflation at the target of 2%, right? When we had inflation rise above these baseline levels, where we're going to mark out in blue here, the Fed target of 2%. Now, the Fed target, this isn't like throwing a dart at a board or a light switch. It's not like you're going to get one CPI report hitting 2% and the Feds are instantly going to pivot or instantly start to shift their monetary policy. They've already confirmed they're not looking to do that because they don't want to repeat the same mistakes the Feds made in the 1970s. When they were combating inflation, inflation just tapped back to their goals for a very short period of time, and they pivoted too early, causing inflation to accelerate and spiral out of control. So it's not like we just hit 2% and Feds are going to pivot. But over here, marked in red, so blue is the Fed target, getting inflation to 2%, but then once inflation hits 2%, maintaining inflation there for an extended period of time. This area overall, from about 3.5 to about 0.5, is the sticky zone. What we call in Capital Hungary a sticky zone. And we'll talk about this. This inflation here, the surge, and then the equal correction you saw take place, which we'll mark out in pink, this was primarily inflation that was 100% influenced by massive stimulus and low interest rates. So when the Feds came on the flip side and did equal to aggressive tightening, it was very easy to correct that upside inflation back into the sticky zone range. You can even see the fluctuations of the CPI reports, which will mark in yellow here, were at very, very similar points where you had any type of minor fluctuation or change, right? So besides these minor points of contention, it was very smooth sailing to correct inflation down from 9% back down into the sticky zone of 3%. But you can see some more contention points we're digging into roughly at 3% here in the sticky zone. Yes, of course, Fed's keeping rates up higher for longer and still continuing their monetary policy tightening is going to impact and still keep inflation lower. It's not like we're going to see, if the Feds keep rates up, that inflation is going to go back to like 6 or 7% for no reason. But maintaining inflation at the 2% target and holding it there is going to take a lot more than monetary policy tightening. It's going to take sacrifices within the US economy. It's going to take wages flattening. It's going to take unemployment rate rising. It's going to take some of these commodity prices and energy prices going down. It's going to take breaking through some of these previous historical contention points as well, right? This is why, as the base effect has been passed, that as we're reaching 3%, this CPI report this week is the first one we've seen in a very long time with a forecast that's higher than expected. we're actually expected with the already set forecast to see this line actually spike up to roughly here, 3.3%. So this changes how this data can be digested. We've already discussed this in Capital Hungry dozens of times in the educational webinars about the base effect, what caused the massive spike in inflation, why inflation has been correcting, understanding the stimulus phase of the pandemic 2020, understanding the tightening phase and the most aggressive rate hike cycle of 2022. But the economy is still far too resilient with the amount of trillions that were flooded into the system during the pandemic period that's still splashing around in the system. Remember, the money supply was increased by more than 15 trillion, right? A couple of those trillions went into, obviously, the stimulus packages and the checks given to the American citizens. The rest of that, the majority of that, multiple trillions went flooded back into the economy from the banks and corporations down the line. These businesses, corporations, various industries, they either reinvest that money into expansion of their business or just back into the markets, like we've seen equity markets rally all the way to all-time highs. But that liquidity is going to run thin and dry with interest rates at above 5% and no more new money entering the market. That free money era from the post-2008 GFC all the way up into the 2020 pandemic, those days are over, right? If the feds were to do any more stimulus again, you're just going to skyrocket inflation out of control, and it's going to be a lot worse than 8-9%. It's going to be starting to repeat those 1970s US problems, right? So we've seen, as we've been trending down, when we were looking at the past forecast, every CPI report was expecting a decline. Every CPI report was expecting a consistent decline, supporting the soft landing narrative. But now, as we're digging into the sticky zone and these previous historical contention points, it's going to take a lot more than monetary policy tightening to be reaching the target of 2% and holding it there. It's going to take weakening in the labor market, which we have yet to see. It's going to take softening in wages, which we have yet to see. It's going to take more softening in GDP projections, which we have yet to see, right? The lag effects of monetary policy are still yet to be fully felt by the US economy, which is really going to be like hitting a brick wall down the line when the lag effects of policy take full effect and a lot of that liquidity and free money runs dry. And now you have interest rates still holding above 5% from the US Federal Reserve, right? Now, the only thing is, higher than expected CPI would, of course, be a factor to take away from the soft landing narrative on the stock market and shake some of that stock market confidence and lead to some deeper pullbacks from those high prices. And it would still keep dollar more bullish. But this forecast and these expectations change everything. If we want to see CPI holding weight to lead to more dollar strength and to lead to more outflow out of equity short term and fading out some of that confidence and greed, we're going to be having to come out right on forecast or higher. If we don't meet this forecast or exceed it, then it's just going to be within these pre-planned expectations. The market's still going to nod it off like, well, it was already expected CPI was going to edge up a little bit. The forecast is already 3.3%, and they're not going to digest it as a major problem. If this CPI report comes out at 3.0% still, 3.1, 3.2, it can still support some short-term greed in stock market and can support some short-term downside in the dollar. We might not see some more fluctuations in these inflation reports until the next couple of months. Okay? So this forecast, being the first forecast where CPI is expected to edge higher, is very, very important. That completely changes everything. If this forecast was the same at 3%, man, that would completely change everything. If the forecast was 3%, I would say, man, we're easily coming out higher than that. We are past the base effect. We're in the sticky zone. We're still seeing wages elevated, the labor market tight, these asset classes at high prices, energy prices still high. We're at this historical contention point. We can easily see our first bounce in CPI and be higher than 3%. But now we really have to come out at 3.3 or higher to be shaking that greed in equities. Does that make sense to everybody? Right? So that's very important. If we want to see more demand in the dollar with the market focus back on Fed tightening and changing that FOMC dot plan, we're going to need to see higher than expected CPI or right above forecast, and dollar also technically trading above 102.8. If we want to see a deeper correction in equity markets and a deeper secondary phase of market structure, aka a pullback phase, to retest this previous liquidity zone that we've broken above, roughly around 34,350, 34,500 key level, we're going to need to fail to break any new higher highs. We're also going to need to break below this 35K price point with right on forecast or higher CPI. That can lead to volatility index seeing a bit more demand, buyers taking profit on equities from these highs, short sellers jumping in, grabbing their piece of the pie, driving price to more favorable demand zones before that inflation data gets priced in and the greedy stock market buyers grab a dip. Otherwise, we're probably just going to consolidate. If we don't get that higher than expected CPI, even still continue the trend and break out into new highs. Make sense to everybody? So that was just a quick little a quick little review first that we did on analyzing market conditions and setting up our expectations. And then that was just a little bit of fundamental review on breaking down CPI, how we're entering the sticky zone, how we can see some fluctuation as we're approaching these contention points from a historical standpoint. But the forecast already expected to be higher changes expectations and changes the narrative a little bit, right? It's already expected. It's already within the forecast there. So we're going to have to be right on the forecast or exceed it to be holding some more weight from that CPI report and still be seeing any downside below 35K on equities in a pullback and upside on the dollar breaking those intraday highs. And if inflation is still just at 3% or lower, that's still supporting the greed soft landing narrative in equities to still see us holding a bit more bullish, taking away some of those rates being up higher for longer narrative points, right? But now jumping into what we have in focus for the next couple of sessions, we just want to understand GJ's ranging at these highs in a secondary phase of market structure, GU showing a bit of indecision here at these intraday lows and previous liquidity zone price. Same thing with EURUSD, same thing with equities, same thing with dollar. I have very little, very minimal, very low expectations for price movement overnight if we don't really get any reactive events and headlines, or if we don't have any technical breaks to be continuing trend. Okay, so first, before we jump into that analysis, we just want to understand what events we do have on the table. So today, nothing was really going on, through the Asian session, except for some China inflation figures with PPI and CPI. Now, China has been dealing with some economic contractions. They've seen a decline in their import and export, a consistent decline. Their PMI figures have been pretty much dropping across the board. And there's already expectations that inflation is dropping here on a yearly perspective with CPI. I don't think this is going to be holding that much market weight. It's something to look out for if we exceed the minimum and maximum expectations here. But overall, for the currency pairs we trade and the asset classes we look at, nothing really going on through the Asian session. Nothing really going on in terms of pre-planned economic data from a medium to high impact perspective over London and European session, and nothing really going on through the North American trading session either. These are just regular business day activity, no auctions, right? Nothing new at all. We see these every week, all the time on schedule. Feds didn't bring no information today or no market impact, and nothing going on from a political or central banking standpoint overnight or tomorrow either, okay? Now, the good thing with gold is, unlike some of the other currency pairs, gold is its own vicious beast. Gold has at least seen a candle body close lower, extending bears in control. Remember, from the last couple of market updates, ever since gold revisited into the 1990s and 2000s, we've shifted into a bearish bias. We know that understanding gold over the course of the last 3 years, that gold has only traded above the 2000s a couple of times. And from a time sensitivity standpoint, it's been very, very short-lived. A fundamental catalyst as large as global lockdowns, massive stimulus, spikes in inflation, global fear, uncertainty, and doubt with COVID, still short-lived here. Russia invading Ukraine, threats of World War III, other countries getting involved, still a short-lived squeeze here. Banking crisis failures with the SVB collapse, Credit Suisse collapse, other banking uncertainty, still relatively short-lived upside above the 2000s. And we can see this very similar sequence of events where we'll have that squeeze above, revisit back into like the 1980s, 1990s, and have a very large correction that takes place. And we've also seen that happen again here. So when we're looking at key price points and you're looking at some of this repetition, it does look like gold could still have some smooth sailing, very slow chugging away though. So I probably shouldn't use the term smooth sailing. Smooth sailing would be better attributed to higher volume and volatility. But it looks like gold could still be chugging away, give or take some aggressive intraday pullbacks down into the 1900s here. We still have bearish price action, bearish sequence of events. And I talked about that in the last higher time frame webinar, which was also on YouTube there. So we still haven't had any major fear, uncertainty, and doubt. We've closed below these candle bodies, starting to just come back to that NFP price grab point. We saw more order flow accumulation during the NFP day that we called live from the previous lows in 1945 retest. Still very strong bearish sequence of events. I would love to see some pullbacks into this area of roughly the 1930s, or even a bit deeper setting up prices, which I don't think we have a high probability of that, or just some of the continuation sells below these lows, creeping our way back down into the 1910s and 1900s. Bringing that information together, we do have to be cautious as we're, of course, seeing a little bit of indecision here. When we're looking at some of these prices, if we fail to break 1925, break above these candle bodies and wicks, then 100% we can have a little bit of a pullback phase first, generate some more sell side order flow from better intraday prices before continuing lower here, which this can even go up to like 1939 in my opinion. So I would actually look for short-term pullback buys highlighted in the green box, roughly above 1927, to retest the first sell area of interest, roughly at these candle body lows around 1934, secondary sell area at 1939. Otherwise, safe continuation sells just breaking these lows, last NFP wick here, and key level 1925. Just watch this little bit of contention here. So the only buy option I see on gold is a short-term pullback buy, which you can scalp or day trade to set up into better sell positions here. Pretty much the same pattern we've been playing ever since the rejections at 1980s, right? GBPJPY. Of course, we've been in more of a macro bullish bias on the Japanese, on GBPJPY, playing the Japanese yen bears with, of course, the ultra loose monetary policy the Bank of Japan is stuck to, and of course, benefiting the macro rate differential of a more hawkish Bank of England, and even playing this beautiful historical repetition we've seen from the post-2008 GFC phase, right? Same thing with the price grab that took place down here with COVID, breaking out of that structure. This was downside from Brexit, of course, downside from GFC, downside from COVID. As Brexit has found solutions, as we're still maintaining that more, as we're still maintaining the macro bulls and macro rate differential of a dovish Bank of Japan versus a hawkish Bank of England, it looks like we're going to be going back to these pre-Brexit crisis prices. Brexit crisis prices. That flew off the tongue pretty smoothly. Now, on the intraday, obviously we have this contention and a bit of resistance there of buyers failing to break higher and a secondary phase of market structure taking place roughly around 183.5, 184. Trading above there, easy continuation buys. If we don't trade above there, then we can easily still see some consolidation occurring. This gives us very smooth trade ideas to take advantage of. So we can see in between the PPLs, we just have a bit of contention pretty much at the last significant higher time frame highs at 184, and then here at 183. If we break above 183, I would be looking for some continuation buys here. And obviously some further buys if we break above those highs at 184. Now be cautious. We might get these 183 buys. Very beautiful intraday range to the highs. It's still more, it's still like 100 pips or more, right? But we might not break those highs right away. So be cautious at those highs still. We would need to see clean candle closures above on an intraday perspective with yen trending lower to still show us that buyer dominance and extensions of trend there, right? This in blue is going to be a bit of a no trade zone area for me. And I can only see any type of deeper pullback plays in short-term further sells on GJ breaking below 181.5, which I would expect us to be retesting into the 180s before jumping back into our bullish bias. So blue area, no trade zone. 183, pretty safe continuation buys above this contention point and resistance area. As at least from this point, we've had a bit of a pullback phase and some more buy orders accumulate. We've seen from here and from here on the intraday. So starting to show a bit of stronger bullish sequence of events of forming. Just need to be clearing above that 183 price point. Now with the 183 buys, pretty clean ranges to be revisiting these highs around 183.8, 184. But you still have to be watching price reactions and validate breaking above there for any safer higher time frame buys. Only see any further GJ sells, which would still be a correction below 181.5. If we do get, for the example of gold, which is heavily affected by risk sentiment, and same thing with GJ, as the British pound is a part of your basket of risk currencies, where the Japanese yen is a part of your basket of safe haven currencies, obviously we always still have to stay on our toes and look out for any reactive events from headlines. So if you do get any major fear, uncertainty, or doubt headlines overnight, obviously don't still be looking for GJ buys or gold sells. You should have the knowledge and capital hungry with a reactive event, understanding the impact, the shift on risk sentiment, and then adjusting accordingly. These are all trade ideas, just discussing if we don't have any reactive events, because we don't want to play guessing games here saying, oh, I hope a war happens overnight, or hope another bank fails, right? You don't want to play guessing games like that. These are trade ideas with current market conditions, current fundamental events in play, and the current economic events on the coming schedule, right? With our dollar pairs, we have to be very cautious here in the example of Euro USD. I would see very safe continuation sells with dollar index breaking into some new highs, Euro USD breaking below this key level and last significant lows. Otherwise, I'm looking for buys above 1.096, buys above 1.0985, and can easily retest this sell side liquidity zone again before continuing lower. It does look like we might have a bit of a pullback phase first, but very clean, simple trade ideas, understanding current market conditions, the phase of the market structure we are in, and of course, where dollar is currently positioned as well. GBPUSD is almost exactly the same, except we had a little bit more of a bounce here on GU on the intraday. I would be only looking for safe sells with dollar breaking higher, GBPUSD trading below 269 and 263. Otherwise, we anticipated within the range here, we could still get bounce buys. I could see GU actually extending to this accumulation area where we had an accumulation of seller order flow and then pretty consistent downside that followed after that. So with GU, if we don't get those safe sells, which I don't think we're going to get right away, we could still see some easily deeper corrective phases, pullbacks into these better sell side liquidity zones, retesting into this accumulation area, even around 1.286 before seeing a consistent sell-off. USDCAD with dollar as the primary in this quote and CAD as the secondary, obviously we've been playing more USDCAD buys. We've been looking at our macro structure where we had a beautiful support created at a retest of roughly this previous liquidity zone of 3.1 and also coming above this key price point of 1.33. And as long as dollar can still chug away, from a higher time frame perspective, we could still be slowly chugging away up to the 1.36s. Currently, dollar's a little bit softer, failing to break those highs, and oil is still remaining a bit bullish as well. This means we have an increased probability where we could see a bit of a pullback here on USDCAD, and that pullback can easily come into this accumulation zone a little bit below key level, roughly at 1.388, before seeing buyers come back into the market and these extensions of trend. USDJPY, I would still be looking for short-term sells below these candle bodies at 143, down to even 141.5, key retest of those zone buys. Short-term sells, otherwise continuations of trend above 143.5. Last but not least is US 30, the equity markets we look at in capital hungry here. Overall, we're in a secondary phase of market structure at these intraday highs, right? VIX is still flat, dollar still relatively flatline. Very nice bounce from 35K, which we called those buys there from the last market analysis if we failed to break. I can only see further sells if we broke this price, and then I would see that deeper corrective leg to retest into that very important liquidity zone, roughly at 34.5 before buyers come into the market. Otherwise, we could just remain steady in this consolidation point I would see buys back above 35.5 and buys back above 35,650, extending the trend. Main focus point is still CPI. Now, I don't want to make this webinar too long. It's almost an hour. I try to give as much information as fast as possible and as organized a fashion as possible. I'm going to save and upload this, and I'll see everybody later.